Would you rather pay taxes on a seed or would you rather pay taxes on an oak tree? Because that's what we're talking about here. Welcome back to the 10 Fears of Retirement podcast. I am Alex Pushman, your host and author of the book. Before I get started, remember, this podcast is purely based on educating our communities and helping you folks nearing retirement and going through retirement, understand your resources, but also understand those common fears that people are coming across and they need solutions. They need strategies. You need a plan. So I cannot stress enough, if you have questions, if you need help, please reach out to us. That's what we're here for. Sign up, get the book. We're going to send you a PDF of it. But also, if you ever like to talk to me or my team individually, please reach out, sign up to touch base with us, and I promise you we'll answer any of the questions you have and give you some good stuff. So before we jump into this, we're in Chapter 7, and this is a doozy, okay? So Chapter 7, Taxes and RMDs, a.k.a. Required Minimum Distributions. So one of the things that I always talk about when it comes to taxes is, number one, joking around, raise your hand if you enjoy talking about taxes, right? And usually when I will say that jokingly, if I'm doing an educational event or I'm talking to my clients and the families I work with, nobody's raising their hand except the CPAs, right? So taxes isn't a fun subject. It's not. It's daunting. Everybody's like, oh God, it's April 15th. Yay. Taxes are tough. They change all the time. Nobody likes paying them. But they're really important to your retirement plan. Something that's really interesting that you have to know is taxes is the number one underplanned area of retirement. Why? Nobody likes doing it. It's really complicated. It's confusing. And again, nobody likes paying taxes. So taxes is one of those spots where I really lean into as a financial advisor and a professional because, number one, there are amazing savings if you dive into that, where you can pick up on your retirement dollars. So when I talk about savings, what I'm talking about is reducing taxes, reducing how much you have to pay taxes on your 401k dollars, IRA dollars, non-qualified brokerage accounts, overall your investments, right? Your nest egg, your life savings. So I'm going to talk about some really important topics that should absolutely radiate and touch base with you and make you think. That's what this is all about. Getting you thinking, understanding, hey, if I have a concern or a fear around this, what are some solutions I have, right? So let's kind of dive into the first thing. So taxes, here's a basic principle, and it's really just to get you thinking. Your whole life you're working, you get a job at, 21, 22, 23, whatever that looks like for you, and you work 30, 40, 50 years of your life, saving. And where does everybody put their money? Well, based on the industry, if you're in the private business, you're going to be putting it into a 401k. Maybe you're a nurse or a teacher and you have a 403B. Maybe you work in the fire or police, space, and you're going to have maybe a 457 and a 403B or a 401k, right? All of these terms, 401k, 403B, 457, 401A, IRA, they're all versions of an IRA. And all that really means is it's tax deferred money. That's why you usually get some form most of the time. You're going to get a tax deduction or a tax credit for putting money into those accounts. So understand why that exists. And then I'll start diving into some strategies and some good stuff for you to walk away with. Number one, there are 3 buckets of money. There's qualified money. That's where your IRAs, your 401ks, 403Bs are going to fall. It's qualified to tax defer. You don't have to pay taxes while it's in there. You don't have to pay taxes on your gains while it's in there. If you buy, sell, nothing. There's no such thing as a capital gain in a qualified account, aka an IRA. Roth IRAs technically are also qualified, but I'll get to those in a second. So you can buy, sell. You're never going to take a capital gain. You're never going to have an issue with that. That's one of the perks, right? So you work your whole life, you get to the end of the road, you're 60, 65, 70, whatever that looks like for you. Now you're retiring. And all those gains you've gotten for 20, 30, 40, 50 years, well, again, whatever that number is for you, now that money is taxable. Okay? When you take it out and you take it out as income, now you're going to pay taxes on it. So I'm going to ask you a question and get you thinking as well. Did you spend more money when you were 22, or do you spend more money now when you're in your 50s or 60s or 70s? Well, odds are you spend more. You have a little bit nicer lifestyle. You'd probably drive a nicer car. You spend more money. So you're probably also making more money, and you're probably in a higher tax bracket. So it's by design, if you really think about this. Hey, we're going to let you defer your taxes your whole life for 30, 40 years. And then when you're adopted to this higher lifestyle, spending more, have more, accounts way bigger than it was when you were in your 20s and 30s, now we're going to tax that dollar. A simple way to look at a great analogy is, would you rather pay taxes on a seed, or would you rather pay taxes on an oak tree? Right? Because that's what we're talking about here. So understand the system is designed, and hey, it's a great thing. It's not a bad thing. A 401k and IRA, I'm not saying it's a bad thing. It's a good thing. You buy, sell, no capital gains. It's great. But I'm gonna help you understand and qualify what's the most important money, what's the second place money, and what's the third place money. All right? So the qualified money is technically, when it say it's qualified, it's just saying that the IRS has given it some type of deal or tax qualification, tax deferral pertaining to the IRAs, 401ks, 403bs. So then let's take it one more step further. What's the other money that's my favorite money? Roth money, right? Whether you have a Roth 401k or a Roth IRA, as soon as you say the word Roth, all that means is your taxes are paid and then the money goes into the account. So now that account is quote unquote tax free. Okay. Now it's technically tax deferred, but when you take that money out, it is tax free. When you get gains on that money and you have profits on that account, that is tax free gains. So if you said, Alex, what's your favorite money? Well, my favorite money is my Roth money, AKA my tax free money, right? Imagine a world where you are retired, you start making your monthly distributions to supplement your Social Security and your pension if you're lucky to have one, and all that money is tax-free. Oh, wait, hold on. The only taxes we now have to pay is on our Social Security benefits? Sounds pretty good, right? You can get into that position. So I'm going to talk about a couple strategies on that in a little bit. So number one, our favorite type of money, or my favorite type of money, is my Roth money. Number two, my IRA money. And then number three, the third type of money, is our non-qualified after-tax brokerage accounts. You know, if you see two people's name on the account, hey, me and my wife are on it, it's joint. If you have a trust account, most of the time, these are the type of accounts that are brokerage. These are the accounts that you pay taxes on every time you profit and hit sell of that position. So, hey, I'm just going to make this scenario up. I have $1,000 in the bank. And one of my buddies at work tells me, hey, there's this great company out there, Tesla, Amazon, Microsoft, right? You name it. And I go buy $1,000 worth of it. And then it goes up 10% and I hit sell. I'm selling off, hey, all I want to do is make $100 and I'm out. So you go make your $100. And now here's the delineation of capital gains. If you hit sell inside of 365 days, less than a year, it's called a short-term capital gain. And the tax rate will be based on your income level. So if you're at a 12% federal level, you're paying 12% on that gain. So you really didn't make $100, you made 88, right? If you're at a 22% tax bracket, 24, whatever your rate is, short-term capital gains, you're going to pay the tax rate of what your income level is at. What's a better scenario? Well, you hold that holding for over 365 days, aka over a year, and now it's a long-term capital gain. You hear people talk a lot about this in real estate. Hey, I need to make sure I hold this holding for X amount of time to make sure I get a long-term capital gain, not a short. So the reason is, and again, I'm not going to go deep into the long-term capital gains tax brackets and all that, but historically and currently, long-term capital gains are less than short-term. So there's opportunities where you actually don't pay anything if it's a long-term capital gain and you have certain income. So basically currently those tax brackets are 0, 15, and 20%. Much better than our income tax level. So understand the three types of money are 100% based on taxes, okay? Roth money, IRA or tax deferred money, and then non-qualified. And that's my order of importance. Your Roth dollars are your most important. Why? They're tax-free. Your IRA, usually the biggest accounts you have, your 401ks, your 403bs, tax deferred, second most important money, non-qualified brokerage, third, because that dollar, that non-qualified dollar, that can be taxed infinitely. Every time you hit sell, you could deal with the taxable situation. Okay, so just understand that basis of the types of money. So now let's kind of dive back into retirement, okay? Historically, required minimum distributions, RMDs, is when you turn a certain age and you are forced to take out money, whether you need it or not. So I'm going to give you a couple scenarios here, but before I do that, I'm going to dive into kind of just the general rules of RMDs. Since 2020, there's been a lot of changes to when you are forced to take out these RMDs or required minimum distributions. And it only exists on your IRA dollars, your 401ks, your 403bs. Those are the only accounts where you're actually have an RMD, okay? Technically, one asterisk to that, if you have a Roth 401k and you leave it in your ERISA employer 401k and it's a Roth, you still have an RMD if you leave it in there. But it's a Roth, so it's not taxable when you take it out. So one of the things we'll talk about as well, a simple way to avoid being forced to take that money out if you don't need it, is you just roll it over into a Roth IRA, okay? There's a deeper conversation to be had there, but just so you know, there is an asterisk on that one. So we get to a certain age, we're forced to take money out, and let me go through that. So the Secure Act passed within the last couple of years, and then there's been a Secure Act 2.0. So there's been a couple changes to these age brackets. So, for example, if you were born before 1949, your RMD age would be 70 and a half. And that's historically what it's been. Everybody says, Alex, I know I got to take them out at 70 and a half, but there's been changes. So, if you were born between July 1949 and December 31st of 1950, your RMD age is 72, okay? If you were born between January 1st, 1951 and December 1959, your RMD age is 73. And if you were born after 1960, your RMD age is 75. So this is actually a good thing. What's good about it is the government said, hey, listen, we're going to give you more time before we force you to start taking money out of these accounts. Now, full transparency, most people retire 62, 55, 68, whatever their number, and they're going to be drawing on these accounts anyway to supplement Social Security, pensions, whatever, part-time work. But there are a lot of people out there who have a very simple lifestyle, and they don't need the money. So this is a great opportunity to start working on tax planning on those dollars. Again, most families, your largest account is going to be your 401k and IRA. And if you haven't gotten to that RMD age yet, and even when you do get to your RMD age, there's still opportunities, okay? But you can start implementing things like a Roth conversion, right? That's a simple one. Everybody's talking about it. It's kind of a hot topic button. I'll talk about it in more detail. But understand with the RMDs, you are forced to take it out. If you do not take it out, okay, at the age that you are required, 70 and a half, 72, 73, or 75, based on your year you were born, there's a 50% penalty on whatever that number is. Not a tax, penalty. And remember, if you're anywhere between 70 and a half and 75, what are you already taking? What are you guaranteed to be taking by that point in time if you qualify? Social Security. So they know your bank account, folks. They can garnish your Social Security benefits. They can garnish your wages, right? So the 50% penalty is a real thing. So I'm not going to get into the exact dates and all the rules, but basically the first year you hit your RMD, they do give you a grace period of roughly a year to be able to take that out. But the year you turn your RMD age, just know you have to take that out by December 31st that year, okay? December 31st that year is just a good kind of golden rule to follow to avoid that 50% penalty, okay? So let's take it into real world. So I'm going to give you two scenarios. The first scenario is a client of mine. I'm obviously not going to use any names, but this gentleman, him and his wife, great savers. I live in Michigan here, and they worked for General Motors. They were both engineers, good, engineers. I know usually somebody's an engineer when they come into my office and they sit down, they pull up their laptop and they got their own spreadsheets, right? My people, the math people. So they both come in. I'm giving them a second opinion at the time. This is probably 7 or 8 years ago. So what happens is they come in, they sit down with me, and we're going through their financial situation. They're good savers. They've made good money, and they're pretty frugal. They have a simple lifestyle. So they only need about $70,000 a year to be comfortable, do their trips, hang out the fam, Christmas, all that good stuff. So they need 70,000. Now, again, they're very lucky because they both had pensions. All right. They worked at a big company here in Michigan and got good pensions. So they both have pensions. They both have Social Security. Between their Social Securities and pensions, they already had about $85,000 coming in. Okay. So the first thing I said to him, I was like, okay, so you guys only need 70, you got 85 coming in, so you got about, give or take, $1,000 extra per month. Yeah, that's about right. Okay, so what about your investments? Now, between the two, again, they were engineers, made good money, good savers. They had over $2 million between the two of them. And they say, okay, we don't need this money, and we're kind of adopted to our lifestyle. And that's one thing I'll just say. Most of the time, people will say, hey, and I've talked about this in past podcasts, but when you retire, it's not like you just fall off a ledge and start spending less money. You're going to spend pretty much the same amount of money. Yeah, you might pay off your mortgage or whatever, but you're usually spending similar to what you have been. And then also, it's not going to all of a sudden go, oh, I'm spending 70 grand, I'm going to spend $150 a year. It's not happening. Very rarely. You may have an emergency or a real estate transaction or you're buying a car, sure, but it's not like all of a sudden you're going and buying Gucci bags if you haven't been buying Gucci bags. You know what I'm saying? So like people are adopted to their lifestyle. I usually don't see wild fluctuations unless it's a life event or an emergency. So these folks have over $2 million. They have pensions and Social Security of around $85,000, and they only need 70 grand a year. They don't really need their investments. So the biggest issue I brought up to them, I said, listen, guys, you got a good income plan. We can make some adjustments to your investments, right? Get those in a better spot to work for you. I go, but the biggest concern, the biggest fear, if I was you, is taxes. Why? Well, they're going to hit, and again, I'll just use today's numbers. At their point in time, they were going to hit age 72, and then they were going to be forced to start taking money out they didn't need. Well, let's just use that $2 million number. RMD tables. So let me expand on this before I go back. RMD tables, what am I talking about? You turn 72. And again, this fluctuates year to year. Secure Act 2.0, it changes a little bit. But give or take, you're going to take out around 3.65, 3.9% when you start your RMD. And then it goes up every single year. So by the time you're 80, you're not taking out 3.65 or 3.85 or 4%. You're taking out closer to 5.15, 5.25. And again, these things can change. So it goes up every single year. So the problem will get worse and worse and worse. And especially if you have good investments and they're gaining compounding interest. So let's just play these folks out. They turn 72. They don't need this money. They have $2 million. And let's just say it's 4% to make it easy for everybody. You're forced to take out 4% on $2 million. So hold on, time out. They just had to take out $80,000 that they don't need. Understand that this is part of the IRS process. The largest distribution of wealth in America is taking place basically in the next 10 to 20 years because the baby boomers, our largest working class, and there's so much money in those 401ks and IRA dollars that they're saying, hey, listen, we don't want you guys to just have that forever. We need to start taxing that money. So the whole reason RMDs exist is they need to start taxing the dollars that they allowed you to defer for 20, 30, 40, 50 years. That's why it exists. They want their taxes. Okay, so it's fine. So now this family, they had 85 grand coming in. They only needed 70. They're forced to take out another 80,000 that they don't need year one of RMDs, again, hypothetically. So now all of a sudden their income went from 85,000 to 165,000. That's a big deal. That's a big deal. Why? What just happened in the real world? They went from a 12% federal marginal tax bracket to a 22% tax bracket federally. And they couldn't have stopped it if they wanted to. And then what do? If you're an educated and a savvy investor, you're going to say, well, I got this 80 grand. What do I do with it? Do I just leave it in the bank? No, they're going to invest that. So then they go open up their non-qualified brokerage account or they got a trust account and they go throw that money in there. And now that money's gaining interest. Now what's happening? They're going to start taking on short or long-term capital gains. So, okay, hold on. Now I had to take 80 grand out and that raised my income level. Now I put this money into a non-qualified account. Now I'm paying capital gains. Taxes. And then if this problem continues, which it will, is now you're getting into the place where you have a risk of your Medicare premiums increasing because of your increased income. So it's really a domino effect here, folks. And you got to understand this is it is by design. The people who are creating this, they're not fools. They're smart. They understand what they're doing. And listen, taxes, I'm good paying taxes. I am an American citizen. I'm happy to pay my taxes, but I don't want to pay a nickel more than I have to, right? And a lot of my higher net worth families really care about this. And especially, when you get into the high net worth conversations, investments matter. Yes. Income matters. Yes, of course. Taxes tends to be the most important thing. I did a review for a family the other day. They were a referral of a client. By us implementing a couple tax strategies, Roth conversions, some indexed universal life for their legacy planning, gifting, QCDs, which is a qualified charitable distribution, which I'll talk to in a minute. We implemented a couple tax strategies. Next thing you know, we extrapolated it over their lifetime, and it was going to save them somewhere in the neighborhood of $700,000-800,000. That's a real number, right? So if you don't have $2 million and you say, Alex, I got $200,000, $300,000, $400,000, it all matters. Would you save $40,000 in taxes if you knew how to do it? Absolutely. So again, it's about being smart. It's about knowing the rules. You can't play the game if you don't know the rules, right? So half of it is having an expert or educating yourself to play that game. Okay. So let's keep going down that situation. So long story short, this family's forced to take money out they don't need. It raises their income taxes. It also affects their Medicare premiums down the road. And then also they start taking on capital gains with the money that they took out that they didn't need. That's not everyone, but I will tell you, for simple families, people who aren't huge spenders, if you've done a good job saving and you're not a huge spender, I'm talking to you. I'm talking to you right now because those are the people who hit the hardest because they don't see it coming. Okay. It's like think about it like this. You're on the shore and you're on vacation and you don't know 2 miles off the shore, there's a tsunami coming at you, right? It's the same kind of concept. You just got to educate yourself to be proactive about these rules because again, retirement isn't the easiest walk of life. It's complicated. It can be very sophisticated. So you got to make sure you know those rules. Okay. So let's keep moving. So RMD is a big deal. I mentioned something about qualified charitable distributions, QCDs. That's one thing I'll throw at you. Let's say you are a person of faith. I am. And you go to church and you are supporting your local church, synagogue, whatever it is, your temple, right? And you give tithings, every single time you go to church, weekly, bi-weekly, monthly, whatever it looks like. And then you can look back, in the fancy apps the churches have these days. You can say, oh, how much did I give last year? What you can do, a really easy thing you can do with RMDs to minimize the taxation is you can say, all right, rather than paying that out of my credit card or my checking account, I'm going to do either a lump sum or a monthly distribution from your IRA or 401k dollars and send it to your church. Then you would get something called a QCD. So it's not coming out of your checking. It's coming right out of your investment account, your IRA. And now it's called a qualified charitable distribution. So now what did you just do? You reduced your tax liability. Why? It's not a taxable event. It becomes a write-off when you send it to the church or a 501c3. You can do the same thing with 501c3s. So qualified charitable distributions is one really nice way to reduce your taxes with something that's probably already happening in your life. It's just not coming out of this account. It's now coming out of this account. Reducing your tax liability, increasing that opportunity to lower those taxes. Okay. So that's a good one. QCDs is a great one. I love it. Roths. I talked about Roths for a minute. Here's the concept of a Roth conversion. Okay. A lot of the times, and I'll kind of talk trash about my industry for a second here. A lot of times when you talk to financial professionals, you're going to get one of two answers when you start getting into the Roth conversions or Roth conversation. The first one is going to say, hey, you're too old, right? I'm a financial advisor and I'm going to play this game. You know what, Mr. and Mrs. Client, you are too old. It doesn't make sense for you. Okay. In my personal and professional experience, I've done over 2,000 second opinions for families. Over 2,000. Out of those 2,000, I didn't read this in a book. This isn't an article you can go read. in my personal experience, it's about 8 out of 10 families I've sat with. It makes sense to do some form of a conversion, Roth conversion. So if I told you it's around 80%, now I'm not saying you convert all of your money in your IRA to Roth. That's not what I'm saying. Sometimes it's a small portion. Sometimes it's half of the account. Sometimes it's the whole thing. It just depends on the family and the income need, how much you're spending monthly, and then how much you have in those IRA and 401k, 403b dollars. So 80% of the time, I've identified, hey, you do have an opportunity to reduce your tax liability by doing a Roth conversion. So I usually Roth conversions, it's an easy one to understand. Here's how it works if you're not familiar with it. You have your IRA or 401k. You pay the taxes on a portion this year, and you convert that IRA dollar to a Roth dollar. So you do have to pay taxes in that year. It is added to your earned or income level, okay? So hey, I'm just gonna make up a number. I make $50,000 a year. I'm a married couple, and I'm gonna convert $30,000 this year from my IRA to my Roth. But we only have 50 grand coming in. Currently, that would keep us at a 12% federal bracket. So often how I'll do it is I'll try to stay within the same bracket you're already in. There are anomalies where, hey, all of a sudden we find out next year taxes for you are going to go from 12 to 30. Well, it might make sense to jump us to the top of the 24 and go convert 300 grand, right? My point being is you want to do your best and you just chip away at it. Very rarely it will make sense to convert the entire account in 1 year. That's how you get yourself into trouble, right? You go convert $300,000 in 1 year and you're still working, it might jump you to the top tax bracket. Now you're paying 37% and you shot yourself in the foot. So understand with Roth conversions, you need to speak to a professional. Every time I do the Roth conversions with my families, hey, I know enough to be dangerous. I'm not a CPA. I'm not an accountant. I lean into my CPA if they don't have one, and I have him verify everything we're doing is accurate. Every single client I talk to, I say, do me a favor, send what we're talking about. I'll give them a nice little software that says, hey, this is what we're thinking of doing. This is how we do it. These are the taxes to Fed. This is the tax to the state if you have them. And I'm sending that to the client so they can send it to their CPA or accountant and verify everything we're doing is accurate. So I cannot stress enough, if you're going to start getting into the tax planning, if you're going to start getting into these tax Roth conversions from IRA to Roth, you need to make sure you're consulting a tax professional, okay? Again, I do this daily. I have these conversations daily. I am not a CPA. You have to make sure you're leaning into those professionals who they're experts in that area, okay? So make sure you have somebody you can trust. And if you don't, again, reach out to us. I can help you out with this stuff. I got a great team, got a great network of people who help me out with this every day, okay? So Roth conversion is a great place to start. Also, you're working. You're contributing. Again, there's details here and variables here. A great way to start maximizing your Roth input is on your contributions, right? So one thing to just say, when you contribute to a Roth, you do have limitations on how much you can put in a year. If you're part of an employer plan, usually those limits are a little bit higher. If you don't have an employer plan that has a Roth, you're going to be limited to about today, and this can change. You're going to be limited if you're over 50 to 8,000 a year. If you're under 50, 7,000 a year. If you have an employer Roth option, usually those limits are higher. You're going to touch base with your HR, understand that. But there are limitations to how much you can do contributing, AKA earned income. If you do a Roth conversion, which is the only other way to get money into a Roth, there are no limits to how much you can do in a year. You don't have to be working. There's no age limits. There's no income limits. So whether you make $1 a year or $1 million a year, whether you're 15, 18, 25 years old, or you're 100 years old, pretty much anybody can do a conversion who has an IRA dollar. Okay. So just understand conversions is one thing. Contributions, earned income is another. So make sure you understand that difference. But I'm always an advocate for getting more money into the Roth. Why? You get tax-free gains, and when you take the money out, it's tax-free as income. And if you don't get through it and you pass away, it goes to your heirs tax-free, which is a great deal. So understand that. HSAs is another good one. Health savings accounts. Those are specifically for medical needs, but also have the same concept as a Roth where it's tax-free on the way out and tax-free with the gains. So I love HSAs. Those are a little bit more complicated with some of those thresholds of how much you can do and your earnings and all that. So make sure you definitely talk to a professional, but HSA is also a great way to minimize taxes long-term. And especially we're all going to have medical needs at some point. One thing I would just say on the HSA, I had a client who came in and I was going through her finances, and this is, again, she was actually a referral of a client. I'm sitting down looking at her and I say, okay, how much do you have in your 403B? She worked for a hospital, and she did some social work. And she said, I got about $400,000 in my 403B. I said, great. Let me see those statements. She hands me the statements. I said, I go, we got two accounts here. I go, one is a 403B, but this is not. This is a health savings account. She had $200,000 in her health savings account. That's a bit much because you have super, super limited options on the HSAs on how you can withdraw it. It has to be for a medical need. You also have limited investment choices, usually in a plan. So make sure you also don't overfund your medical savings or your HSAs. It's good to have them. It's a great tax play, but just make sure you're not putting too much in compared to how much you're putting into your life savings, aka your 401k Roth dollars. So IULs and life insurance. This is a complicated one, but I'll give you an example of what I do for my family. I'm 40 years old today, okay? Not literally today, but I'm 40 years old at this point in time. So I have 4 kids. So forgot about one there. So long story short, when you get to a place where you can, hey, I'm saving into my own accounts, maxing out my Roths, I'm maxing out my SEP IRAs, 401ks, whatever you have, and you say, hey, I still have money to give. You can do something called an indexed universal life insurance. The cheesy call for these is they call them the rich man's Roth, okay? Because how you can use an indexed universal life, and there's other ways you can do this with life insurance, but this is just a good example, is let's say you fund this thing for 20 years and you're putting $10,000 in there every single year. And then at the end of that 20 years, you say, okay, I want to turn on my policy loan. You start taking a loan against your own death. Okay, so you're taking a loan against your own death. Why would you do that? I'll use my wife as an example. We're going to fund her policy for 22 years. She puts $3,600 in there a year, $300 a month. At the end of the 22 years, she's going to put $79,200 in that account, okay? We're not doing it for the cash value. We're actually not doing it for the death benefit. You'll have a death benefit around $350,000. What we're doing is when she gets to the end of that 22 years, we're going to hit a button and turn on the loan. She's then going to get a little over $15,000 a year as a loan against her own death. When you get a loan against a policy of life insurance, it's not taxable. So basically what we've done is we've created a hedge or our own version of a tax-free pension that she will get until roughly about 100 if she lives that long. I have the same thing. I do the same thing for my kids. There's other ways you can use these accounts, but the whole point is it's a great way to have a tax-free income. And if anything changes with Social Security, you have some hedges on that. Okay, so I really like the indexed universal life insurance policies. It's a great legacy planning tool as well to minimize taxes. Hey, I'm going to start funding life insurance policies for myself, for my kids. So when they get that money, it's tax-free. Hey, I'm going to start funding life insurance for my kids. So when they pass away, my grandkids get money tax-free, right? So there's a lot of strategies inside of the life insurance space that can make sense for taxes. But again, you don't want to go too deep down that rabbit hole. I've also seen families where they've gone too deep in that rabbit hole and they're putting way too much money into life insurance and it becomes more of a burden on their monthly income. There is a balance. Make sure you're not being sold a life insurance policy. It should be a solution to a problem you have. That's the whole point of this book. You have a concern or a fear. There are solutions to that, and you need to seek them out with people you can trust, professionals who know what they're talking about. And again, keep good experts around you, CPAs, attorneys, financial professionals, right? Insurance professionals, lenders. So it's very important. Okay, so one of the last things I'm going to talk about, two last subjects, and then we'll wrap this one up. Social Security taxation. So Social Security is taxable based on your income. If you are a single person, and how they figure out how your taxes go is based off of something called AGI, adjusted gross income. So, you can go into Dr. Google, hey, what does AGI mean? What goes into that? What factors go into AGI? And this will help you understand where you're at. So if you're single, there's two thresholds of income. If you make over $25,000 a year as a single filer for taxes, you made over 25 grand, boom, you just went from your Social Security being tax-free under 25,000. Now you're over 25,000, and now your taxes, 50% of your Social Security benefit is taxable income. Okay. So that's important to know. Hey, I'm getting a part-time job. How's that going to affect me? Keep an eye on that stuff. So you can go from zero, under 25 as a single. For the record, if you're married, 34,000 a year is that number. So 25 single, 34 married. If you're under those numbers, your Social Security benefits can be tax-free. If you go over that number now, 50% of your Social Security benefit is taxable. The next threshold for single is $32,000 a year. And then the magic number for married couples is $44,000 a year. As soon as you hit those thresholds, it goes from 50% of your benefit is taxable to 85% is taxable, which is a big deal. So again, real world talking, you're getting a part-time job. Make sure you don't shoot yourself in the foot and make more than that. And then all of a sudden you go from 0 to 50 or 50 to 85 or whatever that looks like. Understand that Social Security is taxable based on these income limits. Last thing I'm going to talk about is simple stuff like where you live. I've seen I'm up here in Michigan. Tons of my clients are moving south. They're going to places like Tennessee. They're going to places like Florida, Texas. Why? No state tax. Now, you have to understand where else those states will have taxation increases, but where you live matters. If you're in California, those are some steep state taxes, right? They talk about this with professional athletes and stuff, but it matters for retirees too. So understand your state taxes, understand where you live matters. It can change on your pension. It can change on your overall income. So all of these things go into the pot. Taxes is confusing. It's not fun to talk about. I could talk another 2 hours about taxes, RMDs, and tax strategies. Oftentimes what I've identified, the best way to understand where you're at is talk to a financial professional like myself, get an assessment and say, hey, which ones do and don't make sense for me? Everybody's different, right? Everybody's different. So I'd encourage you, please reach out to us. I'm happy to do it for you, give you a free assessment that you can set up and talk to me directly. You can talk to my team, and we're going to give you an assessment if you'd like to do that. The whole point is that you can work with somebody that you can trust, that'll shoot you straight. And again, doesn't cost you anything. If we decide to help you, we walk you through what that looks like to implement some of these plans if you want us to do it. But we will give you the solutions, and we're not going to charge you anything for that. I love doing this stuff. I'm passionate about doing it. And again, taxes is a tough one. Make sure you educate yourself on those options. So thank you for joining us. Chapter 7 here of the book. Make sure you get your copy of the book and you're reading along here with me. But if you need anything, if you have questions, do not hesitate to reach out. And again, thanks for joining me. Alex Pushman here, 10 Fears of Retirement. Hope you enjoyed it. We'll see you next time.